All right, so today is Monday, March 10th. This is the 2 p.m. section that's being recorded. Before we dive into anything, I'll just open it up to any questions from anybody that is here today. About anything? All right, well, not seeing any questions, or you can put them in the chat. I'll quickly check in on the Bloomberg Trading Challenge. We got 2 days left. And the market today is pretty ugly, if anybody's been paying attention. All right. All right, we'll start with your section, which is 201. Here is where we stand today. Again, keep under $300,000 of available cash. Assume you're still trading beyond Wednesday. Everybody's got at least 10 longs. That's the current ranking, as ugly as it looks. Short version is trading challenge ends approximately 5 o'clock at the end of the trading day on Wednesday of this week. I will take screenshots, post them for the final rankings. And again, the grade distribution would be first place. So right now, 5, then 4, 4, 3, 2, 1, if we were to end today. But that will be the grade distribution as of the end of day Wednesday. And then basically the Monday, when you get back from spring break, we will restart the challenge, same teams. I'll put a fresh $1 million as essentially, I'll call it 2H for second half. And we'll trade the same rules for the second half of the semester. Okay, so that's section 201, just so the other teams that might be watching on video. Here is section 101 as of today. And again, just really tough market conditions. Staying under 300,000 in cash. Everybody met the 10 longs here. Next, section 301. This is the 2 p.m. section. It's where you stand today. And finally, section 401, which is the 330 section. All right, so before we move on, somebody tell me, why is this so bad? Like, there's not a single team across 24 that's making any money. I don't count because I only did one trade. I got lucky and I stayed mostly in cash. I'd have been disqualified. But what's going on that's causing all this? Why is the market so rough right now? All right, so I see in the chat, the tariffs, absolutely. Tariffs raise prices. We have price wars going on between US, China, Canada, Mexico. It seems like we want to fight the entire world, which we didn't need to. And this is a fight, which if nothing else is raising prices. Prices are inflation. Dylan says uncertainty. Yes. I don't even know what day the tariffs are on versus they're off. They're on again, they're off again. You're gonna change here, change there. Markets like certainty. We know from finance that the primary driver of cost of capital is beta and CAPM. And the primary driver of beta is volatility. So when you get extreme volatility, you get extreme cost of capitals. It's just going to kill the marketplace. The market hates uncertainty, and all we're doing is adding more and more every single day. Market has no idea what the White House is going to force them to do or going to do on their own. And that is just not good for the marketplace. So between that, the trade war, and then the consequences that are coming out of that, higher prices for consumers, which essentially is going to be worse because, and you can see this, EC, FC, the economic forecasts. We looked at this early in the semester when we talked about EIC. One of the things that's kind of interesting, probability of recession is now 25%. Growth, GDP starting to slow. Biggest part of GDP that's slowing, government spending. You don't spend as much as government, GDP goes down. Matter of fact, if you've been reading the headlines, with all of the unemployment that we're now having for all these people that are being laid off, and by the way, you work at the NIH as a researcher, good luck trying to find another job that's comparable anytime soon. So long story short, we're gonna have a bunch of very highly paid, educated people that can't find jobs, unemployment spiking, consumer sentiment is probably diving, and that is a great recipe for what's called recession. We're likely to have negative GDP this quarter. In fact, I'm going to switch to the quarterly view here. And as of today, the market was originally expecting GDP to be in the 2% range, but these numbers in recent days are starting to be revised down. And again, the probability of recession is starting to go up. And that is just somebody took a gun, pointed at its foot, and shot it. Right. And that's what we're doing on the business side. So enjoy the ride. But sorry, I shouldn't be so sarcastic because there's a lot of pain that's actually going on around here because of that. Anyways, and then finally it was it ECSU? Let's look at the surprise index. And let's try and look at the surprise index. It's not loading. There it is. All right. The big negative surprise right now is spending is down. Makes sense. People start hoarding their wallets when things are getting really expensive. And this is another one to watch. This is consumer sentiment. When consumer sentiment starts going down, it starts affecting some of these other things, because if you don't feel good about the future of the economy, particularly in the short term, then you don't go spend money. And housing is also a big mess. So again, we can start tracking this. And I say this because in the Bloomberg Trading Challenge, you're going to have to trade in this environment in the next 3 months. And it's going to be rocky. And just remember, you can sell short. Okay. So I'm not letting you go options to go short, but you can sell short. Right. So, which basically means that you essentially take the stock at the current price and buy it back later. If it goes down, the difference is how you make money. Okay. So if you think stocks are going down, you can short them. If you think stocks are going up, you can buy them. Matter of fact, the biggest short right now in the marketplace that probably would have worked was Tesla. Tesla's high flying. Now people are literally, if you watch, vandalizing Teslas, and essentially Tesla sales are down, particularly in Europe. No one's buying them with the trade wars that are going on, all the ugliness that's going on. And I guess Musk doesn't care about his own company. But in any event, Tesla's down. If I can see that right here. Tesla. And let's just look at the share price. This is Tesla in the last, we'll just do the last 6 months. Actually do year to date, probably a better indicator what's going on. So as you can see, Tesla was flying high at about $400 a share. Today, they're at $227. They've lost 50% of their value in the last 60 days. So back to shorting, if you had shorted Tesla, you'd be cleaning up in the competition. So again, think just back to macro level trades. One of the questions I would be asking myself as a team for the second half of the semester is, okay, if we're in this tough recessionary volatile environment, historically, what types of companies do well in those environments? Like when people pinch pennies, when they don't want to spend money, where do they spend? And does anybody have at least an initial thought before we move on? Like what would be your safety stocks? What would be a defensive stock? If you wanted to protect your downside and not short. Does anybody have thoughts on that? Chat here. McDonald's, Staples, Walmart. Okay. Again, I think each of those could be researched. I know I think we talked about this when we are giving EIC example. One of the challenges with fast food is that people tend to eat more at home when times are tough, and McDonald's prices are not cheap these days. So I don't know if they're going to trade down to McDonald's or trade through McDonald's, but it's at least worth exploring. I think Walmart's another really good example of a company that historically has done pretty well in tougher times as people trade down. Walmart's, Dollar General's, Costco's. The only wild card, which probably involves a little more research, and you can actually see it here in Bloomberg, WMT. You know this from your training, your certification, but the screen is called SPLC, which is the supply chain analysis. So again, the left-hand side of the screen will be Walmart suppliers. The right-hand side of the screen are generally Walmart's customers. And so where is Walmart getting its goods from? Okay. And my only point is a good chunk of Walmart comes from China. That's how they get their low costs. And if we're doing 10 to 25% tariffs and rising on China, I don't know how that's going to affect Walmart. I think that's an open question the market's trying to figure out today. Okay. So again, it's a very complex environment, but I think historically, people tend to go away from the Macy's, Nordstroms, et cetera, and then they trade down to the discount retailers and grocery stores. People always have to eat, even if prices are high. And I think somebody said J&J pharmaceuticals, particularly big pharmaceuticals that are paying dividends, have brands, have patents, tend to do okay regardless of the times. People got to take their drugs. So if you're on a life-saving medication, you're not going to stop it because of tougher times. So I think some of the pharmaceuticals might be another thing to look at if you're looking at a defensive stock during this. But again, I think that's what you guys need to start thinking about. Like, I know we just went through EIC. This semester is going to be a lot more about EIC than individual company performance, given what's happening on the political stage. So it's not surprising that the teams are doing poorly. Although I will tell you, I've been doing this for 17 years. This is the worst I've seen in 17 years. And I'm it's tough. And by the way, it's no different than the real world. There's probably some hedge fund managers out there that are pulling their hair out right now, losing billions and trillions of dollars. But again, trading challenge. All right, questions about that before we move on? Okay, so again, lots going on this week before you guys head to spring break. Hopefully you guys have a wonderful spring break that's safe next week. So basically, let's talk about Wednesday. So Wednesday, your group project presentations will be done in class during the time that your class time is registered for. So for this class, between 2 and about 3:15. Each of your TAs will be there live as the primary grader. And again, I'm going to, health permitting, try and zoom in, but I'm telling you that realistically, I don't think it's fair to you for me to grade you remotely on Zoom if I have somebody in the classroom. So the primary driver is going to be your TA. I'll supervise what they do, but that's who you're presenting to for your grade. They will have a grading sheet that they're going to be filling out, and I'll be very specific with you about what they're going to be looking for. All right. So you're going to do an ROIC tree and CFI on those two companies that I gave you for your group project, right? I'm going to make sure that you do both, that both companies ROIC tree, CFI analysis. You cover not just the 5 years, but the important trends in between. You're using numbers and you're connecting dots, right? You can't just do a presentation where it says the ROIC was 19 and then the ROIC went to 21 and move on. Like I got high school students can do that, right? I need to know the why. What below is causing that to change, right? And then a little real world context on what might be causing some of these things to change. Okay, you got 8 people on your team. Take advantage of that. Take advantage of the tools. And you got 10 minutes to do it, but make sure you cover that. And remember, the 3 questions you're going to be answering is analyze company 1, analyze company 2, compare the 2, looking for major differences and who's doing better. Same as the homework assignment you had for today. Okay, that's your 10-minute presentation. Make sure you cover it all in 10 minutes, 6 teams per section, and we'll have to move along. Put everything in the PowerPoint. Okay, my rule, which I'm going to have the TAs enforce, if it's not in the PowerPoint, it doesn't count. Okay, so if you pull up a spreadsheet, it might be the right information, but if it's not in the PowerPoint, not going to be counted. So everything needs to be in that PowerPoint. And again, context, I always do it for fairness, because if I don't do it that way, the teams that present first are at a severe disadvantage to the teams that present last, because the teams that present last get to see everybody and all the mistakes that were made and get a chance to autocorrect, right? So to mitigate that, that's why I enforce the PowerPoint rule, okay? Because you can't add something at the last minute. Even if you're talking about it, it's got to be in the PowerPoint. Got to have data in this class, just like any other assignment. So back to questions. Is everybody good on what you need to have ready for Wednesday? Any other questions about the projects on Wednesday? Let me go back to Elms just to. Nope, not that one. There's Elms share. I have Elms. I had it open. Start this again. There we go. All right. So the other thing, what? Oh, phone. The other thing on Wednesday is I will open up your midterm exam. So for all sections, of course, you will take the midterm exam through this link right there. And right now, this link is not available to you, I don't think, because I don't have it showing up until Wednesday at 6 a.m. Okay. And you can see here, this link will be available between Wednesday at 6 a.m. and Friday at 11:30 p.m. Okay. Everyone needs to take that exam during that period of time, right? Including those with ADS accommodations, right? So what's going to happen is when you open the exam, it's going to start a timer, okay? And I'm not going to end it after 90 minutes, okay? So the timer will just keep going, but I'm telling you, any exam, unless you have an ADS accommodation that has more than 90 minutes to complete it, will not be graded, and you will just get a 0. So you must submit within 90 minutes of the time that you start the link. So don't just look at it and come back later. That would be very bad for you, because we can't stop that timer. So don't take the exam until you're ready to take the exam. For those of you with an ADS accommodation, you're going to take it through the same link. The difference is I'm going to apply your accommodation to the time. So for example, if you get 2x time, then you have basically, instead of 90 minutes, you have essentially 3 hours to take the exam. But same thing, That timer starts the second you click on that link and finish within the time that you were allotted. Now, you don't have to take it during your section time. You're welcome to. You can take it any time during that range at your convenience. When you click on that link, which I'm not going to do, it is going to basically be a 10 question multiple choice exam. That's it. That's the entire midterm. You do not need Bloomberg. You will not need Excel. It's going to be questions assessing the theory of the class. Now, technically, it's anything that's been on the readings through today, anything in any of the PowerPoint presentations, or anything we have talked about in class. But I will tell you, I am highly likely to ask you a question that we haven't at least brought up somewhere in class, right? I'm not just going to say, you know, oh, did they read the book? So I'm going to ask some arcane question that's buried in the book. That's not what I'm trying to assess here. I'm trying to assess, do you understand what you have been doing with these concepts for the first half of the semester? But it is cumulative, covers the whole first half of the semester. And again, 10 question multiple choice. Every multiple choice question will have none of the above as an answer. They're not as easy as you think they are. And finally, it's open book, open notes, no collaboration, no using past exams or past course materials, right? It's an individual exam subject to the honor code. Questions about the midterm exam? Which I hope, I think I'm still, you can see that screen, right? Oh, sorry, my bad. I've been talking to you with that. I'm assuming you've seen the screen. That is the link. It's called midterm exam. As I said, you can see here. I thought you could see here before. Sorry. March 12th, 6 a.m. is when it's going to show up. March 14th, 11:30 p.m. is when it goes away. That is your range to take the exam. Anytime in that range, subject to your 90 minutes or longer if you have an accommodation. So back to questions about the exam. Any questions about that exam? Okay. And so then, in addition, what do we have here? Peer reviews. So you have a peer review due for this presentation that you're making on Wednesday, Friday, 5 p.m. Make sure you submit this peer review before you go on spring break. You can submit it now, but submit the peer reviews before you go on spring break. Again, my simplest recommendation is take the file you submitted for your first peer review, add another column, resubmit it, make it real easy for you. Okay. And basically, if you don't submit a peer review, what will happen is you'll get -1 points for your grade, and you will not be able to opt out of the final exam. Okay, so it's easy, it should take you 5 minutes or less, because you just put in numbers, you know, to give explanations, right? But again, the way the peer reviews are going to work is when I get around to reviewing the peer reviews, if one member of your team scores you less than 100%, I will not lower your grade. If 2 or more members of your team give you less than 100%, then I will lower your grade. And it'll be on a weighted basis. Okay. So if you have, I'm gonna make it up, no, it's 5 people on your team, but you have 5 people on your team, and 2 people out of the 5, you don't count, give you 80. So it'll be 80, 80, 100, 100 average. So your grade will go down 10%. Right. But if you are peer reviewed down any points, you cannot opt out of the final exam. Okay. So I'm telling you this so you understand the process, but more importantly, I want 100% from everybody. Right. Please participate. Right. And I hope everybody's been doing that. If you have any challenges working with your team, email me. You have my cell phone, call me. Like, I want to make sure I don't see any negative peer reviews. Okay. And I don't want your team to be doing things without you that causes it to hurt you. Right. So if you have any challenges, talk to me now. Don't wait till the end of the semester. It will be too late. Right. And that just applies to anything. Or talk to the TAs in the office hours. Talk to us. Like, don't wait. Right. And be proactive about that. And I say that right now as somebody going through a bunch of medical stuff. My doctors are telling me the same thing. But don't just sit there and don't say anything. You got something, say something. We can deal with it if you tell us. We can't deal with it if you don't tell us. So same principle applies here with the peer reviews or anything else regarding this class. All right. And then again, Bloomberg Trading Challenge ends first half, 5 p.m. Wednesday. Okay. You don't have to do anything at that point. Just don't liquidate your stocks. I will then post the rankings and the grades. Right? You're not going to do the peer review on the Bloomberg Trading Challenge until the end of the semester. So there is a peer review on that, but that's after you do both sides, both halves of the peer reviews for the semester. Okay. So what I want to do today is one more practice and just quickly go over the homework that we just did. So for the practice, I'm going to upload the files because I just did it right before class. What's today, March 10th? So in a folder called March 10th, I'm going to put two files on Southwest, a CFI and an ROIC tree, as in Southwest Airlines. So let me upload these real quick so you guys can grab them. While you're doing that, I'm going to go back to our homework. Homework assignments. So spring break starts. What is that? Homework 8, just so you know, which is the Monday after spring break, requires nothing that you do on spring break. I'll just mention that now. What we're going to do is starting the Monday you come back from spring break, we're going to start building a valuation model. We're going to move into the third section of the class. Your homework 8 is going to basically be to take what you built that day, that Monday, and upload it. All right. So you don't need to prep for that. You just need to come back refreshed from your spring break and ready to go with Excel that day. So you don't have to worry about anything regarding 443 during spring break. And then we'll just pick up from there after spring break. So homework 8 is not an assignment you have to do before that Monday, just since we're on that subject, in case anybody had questions about that. All right, so for homework 7, which was due today, you had to walk through these ROIC trees for starting with whether you did Louis Vuitton first or LVMH first, or Hermès first, the ROIC tree for Louis and Hermès. And I'll start with the ROIC trees, all right? But again, the key here is very quickly, you should have said something about LVMH going from in 2020 7.5% ROIC to 12.4%, although most of that gain was between 20 and 21 when they went from 7.5 to 13.8, peaking at 15.6 in 2022, and then saying about the same in 2023, and then dropping to 12.4 in 2024. But overall, 64.5% gain over the 5 years, right? Why did that ROIC improve so much? Well, part of the reason is the tax rate went down. They were paying 32.8% taxes in 2020, going a little faster today, 28.5% at 2024, right? And basically the biggest drop occurred between 20 and 21. But overall, that was favorable to the pre-tax or to the after-tax ROIC going up, but their pre-tax ROIC also went up, suggesting the business got better. In 2020, the pre-tax ROIC was 11.2%, surging to 17.4 in 2024, peaking at 21.2 in 2022 before receding slightly to that 17.4. Why did the pre-tax ROIC go up? Driver number 2, margin. LVMH's margins went from about 18 cents per dollar in 2020 to 22 cents per dollar in 2024. Right. So that 24% increase in margin was a big driver of the pre-tax ROIC going up. But it actually went up further. Between 20 and 21, it went from 18 to almost 27% margin, which they maintained 26.5 in 22 and then 26.2 in 23 before falling in 2024. Okay. So think about this. There was almost like this parabolic curve where it kind of goes up and then a little down a little. So why? What started to happen in between 2023 and 2024 might be a question that you start to notice a trend. So back to context, give me a sentence or two. Why the margins erode in 2024? What happened? Was it because they bought Tiffany's and its integration expenses? Like what's going on? Right. So just this is what I mean by context. It's not every single number, but if you're looking at this independently, you kind of know the same trend I'm looking at, then like you want to explain a little bit of that trend, right? Invested capital to sales, right? That went from 1.6 in 2020 to 1.285 in 2024. That actually got better, right, to the pre-tax ROIC because they're spending less capital per dollar of revenue. And again, it dropped pretty consistently between 21 and 22, dramatically from 1.4 to 1.25, which is about the range that they've been in the last 3 years. Right. So if you think about the drivers, tax rate was favorable, margin was favorable, invested capital productivity was favorable. All three things were favorable to LVMH's ROIC going up over time. Second level drivers, what was going on there? Well, first, the gross margin went from 78 to 76. That's the difference between price and cost of goods sold. So they're not getting as much markup on whatever they're selling, right? SG&A went from 46.5 to 44.7. So they're getting a little bit of an economy of scale there because they're spending essentially the equivalent of about 2 cents less per dollar on overhead. And depreciation went from 13.5 to 9.2. So that 4 cent per dollar savings also benefited them. And again, that's probably an economy of scale because depreciation is a fixed cost. And you can see on the left in the revenue growth rate, they've been growing at a pretty good mid-single digit clip, 7.6, 7, and 6.3. So that's probably why that depreciation is starting to come down. Right? Now, those three are all working to drive the operating margin. So what's the biggest driver? It's the SG. It's really the depreciation, the SG&A. It's not the gross margins. Right? What's going on with productivity? We added something last week, which is working capital plus PP&E. And there is a third part of productivity, which is intangibles. When you buy somebody, right, the difference in the purchase price and what you paid for them is called intangible, goodwill. Purchase intangibles are part of operating working capital. Think of it this way. If I build a plant or if I buy somebody else's plant to make a product, technically from an operating standpoint, what's the difference? I mean, the primary difference is I usually spend more when I go buy somebody else's plant, but I'm still buying it with the intent of using it. So goodwill is considered operating. That's why intangibles was added in there. Okay. So working capital 17.1 to 18.5, that's unfavorable. PP&E of sales 68.9 to 54.9, very favorable. And intangibles 74 to 55, very favorable. So really, if you think about it at a high level, what LVMH did really well in the ROIC is, despite the fact that they're tying up more working capital, they got a lot more use out of their building, land, and equipment. So probably more people to the same amount of stores. And they leveraged the acquisition that they made, right? Because they're now having less intangibles to sales, right? And we can validate whether that's true or whether they wrote it off when we do our CFI analysis. But overall, is that PP&E sales driving down and the intangibles sales driving down is the primary reason the invested capital sales have gone down. Questions about the ROIC tree? All right, in the interest of time, we go over here and do a quick compare with Hermès. I will just say holistically, if you looked at this, here's a company who's doing really well, right? Their ROIC in 2019 was 38%, which is outstanding. By 2023, it surged to 72%. Okay, so they've been improving and they're growing similar rates to LVMH, mid-single digits. So if you look at what's going on here, their pre-tax ROIC also went up dramatically. It doubled from 54.8 to 101. Again, big surge coming between 19 and 20. Tax rate went from 36 to 28.7. That was a big benefit. Okay, so why is the ROIC, pre-tax ROIC going up so much? Well, their margins went up dramatically from 32.4 to 40 cents per dollar. Imagine how much margin they're making on one of those purses, right? Invested capital sales also got better, 59.2 to 40. So again, like LVMH, all three drivers working in favor of improving their ROIC. Okay. Second level drivers, I'm just going faster right now. Gross margin, 76.5 to 75.8, also went down somewhere at LVMH, about 1%. Right? SG&A, 36 to 29.7. They got a big economy of scale there, saved a lot of money, and depreciation from 8 to 6. But the real driver for their operating margin was the SG&A drop. Okay, so LVMH, it was depreciation. Hermès, it was the it was the SG&A. Why did investing capital sales get better? Unlike LVMH, their working capital got better, 6.7 to 5.5. They're spending less on working capital per dollar of sales. Right now, they went to almost no working capital in 2021. They started to build it back up. PP&E to sales, 48.4 to 31.4. Again, that was consistently low as it went down to 38 in 2020, 31 in 21. It's kind of stayed in that range for the last 2 years. Intangibles, 4 to 3. They don't do nearly as much in the way of acquisitions. Just the size of the intangibles are relatively small. So even though they went down, saved them a penny. Again, their driver of productivity, PP&E to sales. That was the primary reason they got better on productivity. That combined with the reduction of SG&A led to the pre-tax ROIC doubling. CFI. $27.2 billion free cash flow. I would always start there. Don't start no pat. Start free cash flow. Work backwards. Why did they generate $27 billion with free cash flow at LVMH? Well, they generated $96.6 billion of gross cash flow over those 5 years. That's the cash from the income statement. They reinvested $56 billion, which is an average 58% reinvestment rate, leaving them $40.6 billion of free cash flow before acquisitions. They spent $13.3 billion on goodwill, which means purchase price was actually higher than that, just the goodwill, leaving them with 27.2 of free cash flow. If you look at the CapEx depreciation ratio, it started at 97, in 2024 is 145. So down from 174 in 2023, but I would say with 145% CapEx depreciation ratio, they are intending to continue growth in 2025. That was their plan last year. Okay, tariff wars broke out, but in any event. And if you look at the investment goodwill right there, 17.4 billion, 2021. Does anybody know what that majority of that represents? The purchase? What company? Because if this were your group project presentation and that number was hanging out there and you didn't say something like that, -1. That was the Tiffany acquisition. They bought Tiffany's in New York. It's now part of LVMH. All right, 27.2 billion of free cash flow became 17.2 billion of CFI. All right, where'd the money go? Primarily, they put $6.5 billion into excess cash, and they increased their non-operating assets by about $3.5 billion. Right, most of that excess cash occurred the year they bought Tiffany. $10.5 billion increase in excess cash. Okay. If you look at the CFI of 17 billion, where'd it go? Well, 2 billion interest, 2.2 billion, 15.5 billion in new debt. Didn't need it. Why'd they do it? Well, because they paid out $26.5 billion worth of dividends and bought back $4 billion worth of stock. So you buy back, essentially call that $31 billion worth of cash to shareholders, and you only got 17 billion of CFI. That's primarily what this debt is for. Okay. Now, practically, they did increase some debt here, probably related to that acquisition, preparing for it, but they've also been borrowing money the last 3 years. And again, cumulatively, they're borrowing money because they're paying it out. And their dividends went up dramatically. They were 2.4 billion 5 years ago. Last year, they went to 7.3 billion. So they almost tripled their dividends. So spending a lot more to reward the shareholders, generating huge amounts of cash, very high margin company, growing mid-single digits. That's why they're the most valuable company in Europe. Okay, and you can kind of see it right here in the numbers. Okay. All right, and then finally, what's going on over here? What's this? All right, 19, Hermès, not as big as LVMH, but still 12.5 billion of free cash flow, 19 billion from the income statement, 6.4 reinvested in the balance sheet. That averages a 33% reinvestment rate. Notice their reinvestment rate is lower than LVMH. Okay. That gave them 12.7 billion of free cash flow before acquisitions. They only spent 264 billion on goodwill. So they bought a couple of small things. They didn't make a giant acquisition like LVMH did. Clear here and looking at the cash flow numbers. And their CapEx depreciation ratio, which is averaged 169, is 184, right? Which is the highest it's been since 2019. So they are signaling, they are expecting that expansion they've been having to continue. It's clear just by looking at these numbers at the time, right? How did 12 billion of free cash flow become 5 billion of CFI? Well, they bank $7 billion worth of cash as well. Every year they put more and more money into excess cash, right? They bought $1.3 billion worth of non-operating assets, a couple things up above, but relatively trivial given their size. They didn't have much debt, so 119 in interest. They did borrow a little money, $1 billion, a little bit each year. Okay. And again, their dividends also went up dramatically too. They spent almost $6 billion in dividends, 5.9 billion, but they went from about 490 to 2.7. Okay. So they almost quadrupled their dividend over the, actually more than that. It's a factor of 6, 7 over the 5 years. So dramatically rising the dividend as their margins are expanding and their cash flow generation is growing, and they're rewarding the shareholders while growing the business while generating high rates of return. Again, I didn't look at their stock price, but I bet it was doing really well over the last 5 years. All right, and I've done some of the compare and contrast as I've walked there through in interest of time. Questions about that assignment? I actually went slower than you're going to have to go on Wednesday to answer these questions, but hit the highlights. As I said, you need to be scripted, write out some notes, make sure you cover the data. That is the most important thing in the 10 minutes that you have to do. Be organized, practice. All right, so let's practice. So if you have these files on Southwest Airlines, we don't have time to do a compare and contrast today. So we're just going to do Southwest Airlines. I put it in the March 10th folder. Tell me why Southwest Airlines is such a train wreck as you go through this. What's going on with them? So let's go with some groups before I go further. By the way, Dylan, you get bonus star for today for saying Tiffany in the chat. So thank you for that. All right, let's put you in some groups again, give you a few minutes and just go through this. Southwest. So rooms. I'm going to do 3. And we're going to be 15 minutes. So a little faster today. And here's what I want you to do. Minimum. So the team with Daisy, Dylan, Gabriella, Jay, etc. I want you to do the Southwest ROIC tree. Okay. The teams with, sorry, there's a window here I can't get rid of. The team with Alex, Vanya, Enoch, Nathan, Tony, I want you to do the CFI. And the team with Jack, Jackson, Joseph, Stephen, Vikas, I want you to do the comparison. Okay, 15 minutes, come back. That's what we're going to do. Go. All right, welcome back, everybody. Why don't we start out with the first team in room 1, Southwest Airlines ROIC tree.
Yep, I can share.
Share and go through.
are you able to see,
Yes, sir. I can see it.
yeah, so we looked at the ROIC tree for Southwest, and up in 2019, you can see that they had a negative 19.5% ROIC. And in 2020, it spiked all the way up to 10.4% before falling all the way back down to 1.7% in 2023. We're assuming that this negative ROIC is mainly due to COVID and just flights not taking off and basically global economies being shut down.
Mm-hmm.
The peak in 2020, we're assuming, is because of, economies opening back up and people starting to get onto flights.
Okay.
And then moving on to the pre-tax ROIC, we can see this same kind of pattern is reflected where
And
there's
by the way, if I can interrupt you, I think I might have made a mistake. I think I forgot to update the years. So 2019 is probably 2020 and 2023 is probably 2024. So the years are one off. That's my fault, but
okay,
keep going.
that makes a little bit more sense. So yeah, we can see the same pattern over here with a negative in 2020, and then the spike as economies are starting to recover.
Mhm.
Um, moving on. Oh, and then looking at the tax rate, 2020, or I guess 2019 here had a high tax rate compared to the rest of the years. However, it wasn't too high comparing.
Sorry, keep using numbers.
Okay, 2019 had a 27.8% tax rate, which isn't too high relative to the around 26% average from 2020 to 2022.
Mhm.
We did see a slight drop off in 2023 to 22.2%. So the tax rate shouldn't have affected the end of year pre-tax ROIC or the ROIC too much. And then when we move over to the operating margin, we can see here that in 2019 they were operating actually at a negative number of negative 0.422 before again hitting a recovery of 0.109 in 2020, which is, again, we're assuming this is when economies start to open up, people start to get back on flights, they start to see their revenue come back in
Mhm.
before a drop off in 2021, 2022, 2023. And just doing a little bit of research on Google, we found that this is when there's kind of safety concerns regarding airplanes. One of them was Boeing. There were multiple safety concerns with Boeing, and I think we also found a Southwest plane collision that happened
Mhm.
in San Diego in 2021, which may explain the drop off in the operating margin as
I
people
like that. Yeah.
stop
By
to
the way, there's
trade.
one other, just FYI,
Yep.
fuel prices. Remember, fuel prices are really big for the airlines and
Yep, that
oil
was
prices
one
are.
thing as well that we mentioned, that the airline industry as a whole is pretty influenced by like fuel prices and gasoline. And
Yep.
during this time, we saw pretty huge spikes in gas prices.
Mhm.
Then moving on to the IC over sales. If you look over to the second level, we can see that the operating working capital, sorry, this is blocking my view. Operating working capital actually grew in 2019 from negative 0.539 to negative 0.262 from 2019 to 2023. And it also decreased from, and PPE over sales decreased in 2019 from 1.95 to 0.743. So overall, invested capitals over sales did improve. However, operating margin did not improve at all, which kind of explains the slow growth of the ROIC.
Okay. All right. Overall, in the interest of time, good job. One other context, if I had given you Delta Airlines, what would have been interesting is they had a similar pattern in 2019 to early 2020. You lose 80% of your revenue, like there's nothing you can do. When people came back, they got better. The difference is Delta kept getting better between 20 and 24. Southwest kept getting worse between 22 and 24. So something's going on with that airline. I think you started to identify they fly the 737 and Boeing's problems have spilled over to them. So again, really good context in what you said. So that's what we're talking about on Wednesday. It doesn't be a huge amount, but just seeding into the presentation is helpful. So for what you did in a short period of time, good job. Let's move to the CFI team. What's going on with Southwest Airlines CFI?
You want me to share my screen?
Please.
Yeah. You see it?
Yes.
Okay. So since this is also like since this is 2020, you can see this is where they lost all their their cash flows. And that's why their free cash flow in this year is so low. And then because there were no planes in the sky. So
yeah.
Then on 2021 is when they recover a lot and their free cash flow and gross cash is much higher because the gross cash flow is much higher, but their
use numbers.
Because their free cash flow is now now it's this year it's 3,225, yeah, 3.225 billion. And then instead of them losing 2.57 billion in free cash flow the previous year. But so you can also see their capex over depreciation is really low. It's -1% because they weren't trying to expand too much this year. And then in the years after this, so they, like the gross cash flow, their free cash flows, they'll start going back down. Now this year they lose 17.5 million. I mean 17.5 million in free cash flow. And that's I don't remember which year it was, but the Boeing stuff. But yeah, it was like
I need to change some things in the model, but it's like
this was the that
yeah.
1 second.
All right, keep going.
Okay, so these were the years that the Boeing started becoming an issue. So that was like that might be why their gross cash flow is decreasing in 2022, 2023. Right, and then so if we look down here, we find they increased a ton in debt in 2020 because they needed to cover for their expenses, I imagine, without having very much cash flow as income. But so their debt is a little bit better, and so that's why they took out $8.2 billion in debt, and then next year it's better. They only take out $81 billion in debt because they're finally starting to recoup some of their losses.
Right, yeah.
Well, the other big thing is if you look, not only did they issue the 8 billion in debt, they issued 2.3 billion of stock
Oh yeah, I didn't.
down there.
Yeah.
So every other company we've looked at so far has been buying back stock, and they bought back a little bit, but they really were more about issuing the stock.
Yeah.
Think of it as like, rainy day fund because in the crisis. And then they haven't really recovered. One other observation, which would have involved just knowing more about Southwest Airlines. If you go up to the top, where it says CapEx depreciation, it's 90%, which suggests they're not trying to grow. And that was 2024. The problem was not that they weren't trying to grow. The problem is Boeing can't give them the planes that they need to grow. So their CapEx depreciation is limited by their customer or their supplier because they ordered a bunch of planes that Boeing said, sorry, can't make them. And that's been another drag on Southwest because they had to cancel a bunch of their growth plans because they don't have the planes. So it's not that they don't want to grow, they just can't. So anyways, so again, good job in a short period of time. Just to give the final team some time. What did the final team talk about? Room 3. I looked across things.
So,
Josie, yeah,
yeah, I'm not gonna pull up, or I can't pull up the
Just
ROIC tree or
summary is
but
good.
just overall, both the ROIC tree and the CFI showed that 2019 was a really challenging year for Southwest, and although they were able to rebound in 20, or I guess if the years were off by one, 2020 versus 2021, it showed that they steadily fell back down on the years that followed. And this was partly due to, or I guess the initial drop was mostly because of the pandemic, but I do know that the 730 Max is getting grounded started as soon as 2019, so that definitely didn't help. And then I think the long-term effects of those planes being grounded and needing to find a replacement for that has continued in fact, especially with the capital expenditures in 21 and 22 moving forward.
Yeah, and another good industry call out, because the whole industry's been facing that issue with Boeing. And when you say find alternatives, Airbus is a giant waiting list too. So it's not like they could just say, hey, Airbus, give me a bunch of planes. All right, well, again, I think, you know, the gist of what you guys did in 10 or 15 minutes is a really good start for what we're going to see on Wednesday. So I'm looking forward to those presentations. You guys are starting to talk more and more like analysts, and I see some progress here. So with that, if there are no other questions, I'll turn you guys loose to finish working on the data for Wednesday, and looking forward to hearing what you have to say. Make sure you turn in your PowerPoints by 10 a.m. Day of class. Have a good day.
Thank you.
Thanks.